If you use a vehicle for business, it's eventually going to wear out or lose usefulness over time, which is why we claim depreciation expense when claiming actual operating expenses for a vehicle. But for many vehicles, there are limits as to how much depreciation you can claim in a given year. In this video, I'm going to look at all that goes into claiming depreciation expense for a passenger vehicle used in business. I'm the Tax Geek, and here is vehicle depreciation oversimplified. All types of vehicles are used in business, from ordinary passenger cars and SUVs to service vans to large semi-trucks. And different rules for claiming depreciation apply to different vehicles depending on the size of the vehicle and how it's equipped. This video specifically covers depreciation of ordinary passenger vehicles, SUVs, small trucks, and vans. These vehicles have a high likelihood of both personal and business use, so there are limits as to how much depreciation you can claim on these vehicles in a given year. Vehicles that fall into this category are a type of listed property. The category of listed property also includes other assets that have the potential for both business and personal use, such as photographic equipment or video or audio recording equipment. If you're claiming the standard mileage rate rather than actual expenses, depreciation, and thus depreciation limits, does not apply to you. Depreciation is built into the standard mileage rate. Vehicles, like all other long-lived business assets, are depreciated using MACRS. If you're wondering what MACRS is, there's a video specifically for that. Click the card above or the link in the description to be taken to that video. Under MACRS, a 5-year recovery period applies to all vehicles, except for semi-trucks, which have a recovery period of 3 years. Special depreciation and the Section 179 deduction can be taken on vehicles as well. Ordinary passenger vehicles, trucks, and vans with a gross vehicle weight of less than 6,000 pounds are subject to limitations on annual depreciation. However, not all vehicles under 6,000 pounds are subject to these limitations. Ambulances, hearses, and taxicabs, but not rideshare vehicles, aren't subject to limitations on depreciation. If a vehicle under 6,000 pounds gross vehicle weight is specially kitted out and made unsuitable for personal use, it is also not subject to depreciation limitations. So how do vehicle depreciation limits work? Vehicle depreciation is limited to the amounts shown in this table based on year of ownership. These amounts are different whether special or regular depreciation is taken in the first year. These limits also increase annually in line with inflation, but for any given vehicle, the limits stay the same for its entire recovery period. To start with, the amount of business use of the vehicle must be determined. This is done by keeping track of the mileage driven for both business and personal purposes. The procedure is the same as when claiming the standard mileage rate. To learn how to properly track vehicle mileage, click the card above or the link in the description. To calculate the business use percentage for the vehicle, divide the miles driven for business by the total miles the vehicle was driven during that year. Once the business use percentage of the vehicle has been determined, that percentage is applied to the original cost or basis of the vehicle, adjusting the depreciable basis. Then, based on the year of ownership, the appropriate MACRS depreciation percentage is applied to the adjusted basis. This gives us a tentative MACRS depreciation amount. The depreciation limit for that year of ownership is also multiplied by the business use percentage. The tentative MACRS depreciation is then compared to the adjusted depreciation limit, and the lower of the two is the amount of depreciation that can be deducted, with an exception we'll look at later. Time for an example. James is a self-employed real estate agent, and this is his 2022 BMW he purchased new for $84,500 in 2022. During that year, his mileage log shows he drove the BMW 75% for business. Let's calculate his depreciation expense for his first year of ownership. He's going to claim special depreciation for the first year. To figure his tentative special depreciation, he multiplies the $84,500 basis of the vehicle by his business use percentage of 75%, giving him a tentative special depreciation amount of $63,375. However, the vehicle depreciation limit for the first year of ownership when claiming special depreciation is $19,200. James adjusts this limit by taking 75% of this amount, which gives him an adjusted vehicle depreciation limit of $14,400. Since $14,400 is less than $63,375, $14,400 is the amount of depreciation expense James can claim on the BMW for 2022. Starting with the second year of ownership, the depreciable basis of the BMW is reduced by the special depreciation James took in the first year. This gives him a new basis of $70,100. Let's move ahead to 2023. For this year and all subsequent years, to keep it simple, we're going to keep James's business use percentage of the BMW at 75%. The revised basis is multiplied by the business use percentage, and the result is multiplied by the 32% MACRS depreciation rate for year 2, giving a tentative depreciation amount of $16,824. This is compared to 75% of the $18,000 depreciation limit for the second year of ownership, or $13,500. Again, since $13,500 is less than $16,824, $13,500 is the maximum depreciation expense James is allowed to claim for 2023. This chart shows the depreciation for the entire 6-year recovery period of the vehicle. Notice the depreciation in year 6. Even though the regular MACRS depreciation was just $3,028, he's still allowed to claim depreciation up to the annual limit, which for this year is 75% of $6,460 or $4,845. This is because he has $17,685 in depreciation he was not allowed to claim in years 1 through 5. He is allowed to claim this disallowed depreciation up to the maximum allowed for that year. So what happens to the remaining depreciation James was not allowed to take during the 6-year recovery period? James gets to take this depreciation up to the maximum allowed in the subsequent years until the entire cost of the car is recovered. As you can see, this happens in 2030. Passenger car depreciation is claimed in Part 5 of Form 4562. In Part 5, you'll see the special depreciation James took for the vehicle in 2022 on line 25. You'll also find information on the type of miles driven, plus additional information the IRS needs for vehicles being depreciated. Since James has no employees, he does not need to fill out Section C of Part 5. Moving ahead to 2023, and you can see the depreciation James took for that year on line 26. Depreciation of vehicles is a complex subject, and there are additional details I didn't cover in this video, particularly concerning the Section 179 deduction. You'll find links to additional resources and information in the video description. If you found this video informative, please give it a thumbs up and share it with anyone who would find it useful. Subscribing to the channel and clicking the bell gives you immediate access to new videos. And as always, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.